Assalamu alaikum, beautiful people. My name is Bint-e-Atif. Welcome to Smart Commerce Classes. Today we are doing 7707 Summer 21 Question Paper 24. Moving towards question 1. The following information has been extracted from the book of Sanita for the month of August 2020. Requirement is prepare the sales ledger control account for the month of August 2020 balance account and bring down the balances on 1st September 2020. So we are required to make sales ledger control account. So for that we have sales ledger credit balance, opening balance, debit balance, that is opening 105,38,440. Then we have checks received from credit customer dishonored. Then we have contra. Then we have discount allowed. Then we have interest charged to customers as we are making sales ledger control account. So cash sales won't be considered. We'll only consider the credit sales. Then we have irrecoverable debts. Then we have receipts from the credit customers, returns from the credit customers. Then we have sales journal totals, that is the credit sales. Then we have the sales ledger credit balance and debit balance, that is the closing balance. So we are required to make balance BT and debit and credit balance. Balance BT, that is on 1st August. We have 38,440. Then we have 105. Then we have sales return. Then we have bad debts. Then we have bank or cash received from credit customers. Then we have contra. Then we have interest charged on overdue amount. Then we have dishonored check. Sorry, that's checks. Okay, sales were 26,845. Interest was 125. Dishonored check was 88. Contra was 315. Bank was 30,121. I forgot to write discount allowed. Discount allowed. That was 692. We have bad debts that were 460. Then we have returns. Sales return of 763. Now we have balance CD and balance CD of 148. Three eight four forty plus 26845 plus 125 plus 88 plus 148 will give us 65,646. So we'll deduct 105 from 65,646, 65,646 minus 105 minus 763 minus 460 minus 30,121 minus 315 minus 692 equals to 33,192. Then we have balance BD. $148. Balance BD of 33,192. Dates are very important. So Okay, moving towards B part. State one purpose of preparing a sales ledger control account. Sales ledger control account helps in detecting the fraud and errors in our records. It helps in formation of statement of financial possession as from sales ledger control account we get trade receivables and sales balances that is used in making income statement and financial possession as trade receivables goes into the current assets column and sales goes in the profit and loss account and helps in calculating the profit for the year. And it proves the arithmetic accuracy of sales ledger. It assists in locating errors. It provides a summary of transactions relating to trade receivables. It enables a statement of financial position to be prepared quickly. So any one advantage could be written over here, or purpose could be written over here. Then we have Sanita prepares a bank reconciliation statement over every 3 months. She provided the following information at 31st August 2020, debit balance in cash book at 31st August. We are required to prepare a bank reconciliation statement at 31st August 2020 showing the balance on the bank statement on that date. So we have balance in cash that is debit balance in cash book at 31st August 2020 6416. Then we have that is a debit balance. So we'll add unpresented checks that are 98,825. Then we have uncredited check that will be deducted. I'm sorry. Balance in cash is a debit balance, so we'll deduct unpresented checks and we'll add uncredited checks. Sorry. We have uncredited checks of, there are two unpresented checks. One is uncredited checks, sorry. Uncredited checks are 2460 and there is an error made by bank of 250. So we'll add 2710. 2460 plus 250 equals to 2710. So we'll add 2710 to 6416 and deduct 98,9825. So it will give us balance as per bank statement of 1353. Moving towards D part, advise Sunita whether or not she should prepare bank reconciliation statements monthly rather than every 3 months. Justify your answer with two advantage and two disadvantage. As this question is of 5 marks, so you'll write two advantage, two disadvantage, and 1 marks for the evaluation, one opinion points. So you can write that if you can write advantages on monthly reconciliation, as you can write that it helps in detecting the errors and fraud in the accounts in the cash book. It helps in it helps to identify the missing entries in the cash book. It helps in out of date checks to be identified earlier. It helps in bank account to be reviewed regularly. But a disadvantage of reconciling after every 1 month is there are more transactions to record. It may be costly. It may be time consuming. If we reconcile after 3 months, so it may take comparatively less time consuming than reconciling after 1 month. It may be less costly. There would be less transactions to record, but disadvantages are errors in the cash book are identified later as if we reconcile every month, so errors and frauds will be detected and rectified on timely basis. And if we reconcile after 3 months, so errors and fraud will still be in our books and it would be identified later. So missing errors in the cash book will be identified later. Out of date checks are identified later. Balance on bank account are reviewed less frequently and acts less as a deterrent to fraud. So less fraud and errors are identified if we reconcile every 3 months, after every 3 months. So question two. One is a sole trader. She maintains a full set of accounting records, including a 3-column cash book. On 1st September 2020, Juan had the following balances in her cash book. So we are required to make complete Juan's cash book on the opposite page, balance the cash book and bring down the balances on 8th September 2020. So first of all, we'll write balance BD on debit side as cash has a debit balance. We will write balance BD 80 in cash column. We'll write balance BD on credit side of bank overdraft of under bank 630. Then we'll write paid 35 motor repairs in cash. That means we had paid motor repair expense in cash. So the entry would be motor repairs debit and cash credit. So cash is reducing. So we'll write it on the credit side under cash column of 35. Cash sales 458. That means cash to sales, cash debit, sales credit. So cash is increased. So we'll write on debit side of under cash column 458. Then it's written paid all cash into bank except 50. So we'll write paid all cash into the bank. So cash will be decreased and bank will be increased. So bank debit, cash credit. And we'll write 453 as we had 80 in the account and sales were 458 previously. So we'll add them and deduct 50 because it is written that paid all cash. That means all cash which was previously in the cash column was paid into the bank except for 50. So 458 plus 80 minus 50, that means 453 is written under the bank under the cash column on the credit side. That means cash is reduced, and on the debit side, we'll write under the bank column of 453 as bank is debit and cash is credit with amount of 453. Fifth adjustment is received a check 1280 from Alicia, a credit customer. We have received check. That means Alicia, a credit customer, is reduced. So check, that means bank has increased and Alicia, a credit customer, has decreased. So bank debit and Alicia credit. So it will also come under the debit side of under the bank column. We'll write 1280. Then we have a check received. Then we have paid a check to Lucia to settle an outstanding invoice from April 2020 of 840 less a cash discount of 2.5%. That means that we have paid Lucia 840. We have paid the account. Lucia was Lucia, a credit supplier. We owed her 840. Now we have paid her after deducting 2.5% on 840. That means 21 is 21 is the discount received, which we received, and we have only paid 819 out of the 840. From 840, the total amount that Lucia owed us, we owed Lucia was 840. We got a discount received of 21, and we paid her 819. So Lucia, so on the credit side, we'll write discount received. Under the discount received column, we'll write 21, and under the bank column, we'll write 819. Then we have a check received 200 from Cow in August 2020 was dishonored by the bank. That means we'll write on credit side under the bank column, we'll write 200. Then we have question B. Juan returned damaged goods to Lucia, a credit supplier. Name the business document Juan issued. Juan is a customer and Lucia is a credit supplier. If a customer sends the return goods and send a document, that would be debit note. If a credit supplier agrees that the damaged goods are if the supplier agrees to the damaged goods, so he sends the credit note. So the answer to this question would be debit note. Then we have Seabird. On 1st October 2020, Juan had a positive bank balance but was concerned about the business's liquidity. Juan believes her working capital can be improved. She is considering 5 courses of action. State whether each of the following courses of action would increase, decrease, or have no effect on Juan's working capital. Give a reason for your answer in each case. The first one has completed for you as an example. It is written, introduce additional capital in the business bank account. So the entry would be bank is increased and capital has also increased. So bank debit and capital credit. So what would be the effect on the working capital? It will increase as capital is a credit, have a credit nature. So when capital will increase, there would be a credit, it will come under the credit uh, entry. So the bank took capital, so capital has increased. Reason is bank increases, so current assets increases. No change to current liability, as we are not owing any money to the bank or the creditors. Then we have sell surplus non-current assets. As we sell non-current assets, so the entry would be if, for example, if we have sell or surplus of non-current assets in cash, so cash or bank would increase and non-current assets will decrease. So there is no entry or no entry of the capital, so there will be no effect on the working capital. For in this question, you have to make the journal entries, and then you'll see if in the journal entry, if the capital comes, so there will be effect on the working capital. If there will be no entry of the capital, so there it won't be affecting any working capital. So as bank increases or cash increases, so current assets increase, as current liability increase by the same amount as, or sorry, bank increases as current assets increases, as we sell surplus non-current assets, so by check or bank, so bank or cash is the comes under the current assets, so current assets will increase, and non-current asset is a non-current assets will decrease, so so there will be no change in the current liability and no change in the capital. So we have obtained a short-term bank loan. So it will increase our bank or cash, that will increase the current assets. And short-term bank loan, that means current liability will also increase. Short-term bank loan means that we have to repay the bank loan within a year, within 12 months. So it will increase our current liability. In this adjustment, the entry would be a cash or bank debit and non and current liability credit. So there is no effect on the working capital. Then we have reduced credit sales and increased cash sales by the same amount. This will also have no effect on the working capital, as we have Credit sales have reduced. Then we have reduced credit sales and increased cash sales by the same amount. As it is written that we are reducing the trade receivables and cash is increasing. So there will be no change in the current assets, no change in the working capital, and there will be no change in the current liabilities. Moving towards reduced credit sales, create a provision for doubtful debts. So any change in the profit or expenses or income will have an impact, a direct impact on the working capital. So the doubtful debt is an expense. So it will increase or decrease the profit. So it will have a direct impact on the working capital. So as we are increasing the provision of doubtful debts, so it will reduce the profit and reduce the working capital. As in the capital in the balance sheet, we write opening capital plus profit less drawings equals to closing working capital or closing capital. So if less profit will go in the statement of financial position under capital column, so there will be less closing capital. So it by creating provision for doubtful debt, the working capital will decrease. Trade receivable will also decrease as provision reduces the trade receivables. So current assets will also decrease, and but there will be no change in the current liabilities. Then we have question 3. Nomi opened a manufacturing business on 1st October 2019. So we are required to prepare the manufacturing account for the year ended 30 September 2020. We have purchases of raw materials. We have opening and closing finished goods, inventory, work in progress, and raw materials. So we are required to make cost of raw material consumed. We have opening raw materials. We have purchases of raw materials. We have closing raw materials. So we have opening raw materials of we have closing raw materials of 11,200. We don't have any opening balances of inventory, so the opening raw material would be 0. The purchases would be 42,100 and the closing would be 11,200. So the net would be 30,900. Then we have direct expenses or direct labor. We have direct factory wages of 46,220. We have royalties. We have factory overheads. We have indirect factory wages. We have factory general expenses. We have factory rent and rates, and we have factory machinery and loose tools over which we have to calculate the depreciation. We have direct factory wages. We have royalties. These costs add up to make the prime cost. Then we have factory overheads. That are factory general General expenses. We have rent and rates. We have depreciation on factory machine and used. So we have there were no additions in non-current assets were purchased during the year. Factory machinery is to be depreciated at 15% on cost. Office equipment, we won't consider it in the manufacturing account. Office equipment will go, depreciation will go in the income statement. Loose tools are to be revalued at the end of each financial year. Rent and rates are to be allocated two-third to the factory and one-third to the office. Irrecoverable debts of 400. That is that will go in the income statement. So we have direct factory wages of 46,220 plus 480. That will add up to make 46,700. Then we have royalties of 3,900. 30,900 plus 46,700 plus 3,900 will give us 81,500. Then we have factory general expenses of 86,020. We have indirect factory wages as well that are of 15,940. We have rent and rates that were two-third and two-third. Rent and rates. Okay, it is written rent and rates were prepaid. It was also written that wages and salaries of factory workers were accrued 480. So that's why we added 480 in the wages and salaries of the factory workers. So we have 8400 minus 600, on which we'll multiply 2 by 3, and that will give us 86,620. Then we have depreciation. Depreciation is 15% on cost, that is 80,000. So it will make 12,000. Then we have loose tools. So the loose tools value were loose tools at valuation was 670 that were closing, and we had opening of 800. So 1200. So we have 800 minus 670, opening minus closing, that will give us 130. So 8620 plus, sorry, it is 8620 plus 5200 plus 12,000 plus 130 plus 15,940 will give us 41,890. So we'll add this in the prime cost to make 23,390. Then we have work in progress. Work in progress. Opening balances of the inventory are not given, so the opening work in progress will be 0, and we'll write closing work in progress. Work in progress, that is 1680. So we'll deduct 1680. It will give us 121,710. That is the cost of production or cost of manufacturing. Manufacturing cost. Cost of manufacturing. Okay. Or cost of production. Then we have Nomi knows that the factory machinery is old and is considering replacing it with more efficient machinery. The old machinery would be sold at book value and the new machinery would cost 100,000. Nomi wishes to know how the purchase of new machinery would affect the profit for the year. Requirement is to complete the table to indicate the effect of on the profit for the year end of the following. First one has been completed as an example. Annual wages of factory workers would decrease by 3,000. As wages of factory workers goes in the manufacturing account, and manufacturing account, the cost of manufacturing account or cost of production will go in the cost of sales or in the income statement. So if the cost is increased, so it will decrease the profit. As it is written, the annual wages of factory workers is decreased. So there will be increase in profit. As cost is decreased, the profit will increase. So it will come under the increased profit for the year. Then we have machinery repairs 1100 included in the factory general expenses were decreased by 60%. As we as machinery repairs of 1100 that was included in the factory general expenses that is decreased by 60%. That means previously we have written 1100 that was now it is decreased by 60%. That means now it is 660. That is decreased. Now it is only 1100 minus 1100 into 40%, that will be 440. Now the machinery repairs is only 440 and we had previously written it on 1100. So it will also increase the profit by 660. Then we have cost of raw materials used would decrease by 10% as cost of raw materials were 30900 and it is decreased by 10%. So that means only 90% will go in the uh, income statement. So 10% of 30900 will be 3090. 3090 will increase the profit as 3090 is deducted from the cost of raw materials and it will increase the profit by 3090. Then we have total cost of the new machinery would be financed by the loan on which annual interest of 4% would be charged. As the loan as the new machinery would cost 100,000. So 4% of 100,000 would be 4,000. So interest decreases the profit. So it will decrease the profit by 4,000. Then we have new machinery would be depreciated in equal installment over 8 years. New machinery new machinery as existing machinery is of 12,000 and the new machinery would be 100,000 as it is the cost and it would be installed over 8 years. That means it will be depreciated over 8 years, the useful life. So 100,000 divided by 8 would be 120, 12,500. Previously, the depreciation was 12,000. Now it is 12,500. So the depreciation charged has increased by 500. So it will decrease the profit for the year as 500. The depreciation is an expense as if the expense will increase, the profit will decrease. So we have 3,000 increased profit, 660 will increase the profit, 3090 will increase the profit, 4,000 will decrease the profit, and 500 will decrease the profit. So the net amount would be 2,250. Moving towards, okay. Allah Hafiz for today's video.